A delayed welcome to Bloomberg Open Interest. I'm Dani Burger. Matt Miller is on assignment, and we are delayed after a roughly hour-and-a-half speech in Davos, Switzerland from the President of the United States. It was supposed to mostly be about affordability. We got a little of that and a lot about Greenland. We're going to get more into what he said, that they won't use force, but that initially sent stocks higher. We are just under an hour into the equity open of the cash trade. We're higher by about 0.75% for the S&P. Tech outperforms, with the Russell 2000 outperforming even more, up 1.33%. It was an ugly day on Wall Street yesterday, falling at one point more than 2% after a mix of fears over Greenland and higher Japanese bond yields. So let's get to that point that did allow stocks to rally. It was President's speech in Davos, where he addressed the elephant in the room, Greenland.
We probably won't get anything unless I decide to use excessive strength and force, where we would be, frankly, unstoppable. But I won't do that. Okay? Now everyone's saying, oh, good. That's probably the biggest statement I made, because people thought I would use force. I don't have to use force. I don't want to use force. I won't use force.
Let's bring in RBC Capital Markets Head of U.S. Equity Strategy, Lori Calvasina, who's been patiently sitting next to me, watching the speech alongside of me. There was so much in there. But after Trump said that, you did get this rally in markets. Yesterday, does that give us any signal to what equity markets are trading on, be it Greenland, be it JGBs, or something else completely different?
Well, look, I think we're sort of in a weird start to reporting season, and we had actually said in our latest weekly that, you know, if you look at reporting season, it gave investors a chance to refocus on the micro and put the macro aside. And unfortunately, we just haven't been getting a ton of companies that are coming out, right? So the macro is still sort of filling the vacuum. You know, what I will tell you is that the first week of January, I was talking to investors based outside the U.S. that week. And we spent a lot of time on geopolitics, you know, a little bit on sort of the kind of bread and butter outlook issues, but it was really a lot of Venezuela and a lot of Greenland, to be honest. Last week, I was talking to stateside investors, you know, people who are based in the U.S., and we were talking more about the bread and butter outlook issues. We very rarely talk about, you know, sort of geopolitics and kind of policy issues in those meetings, I would say, in normal times. But we were getting questions on how we thought markets would price in this kind of geopolitical risk. When would markets start to react? So I do think it was on the minds of people stateside as well.
I wonder if internationally, because you do see a little bit of that trade happening, just take this week as an example. U.S. equity markets are off on Monday, and you get a pretty steep sell-off in the European trade. It does continue into the U.S. trade. Is there a sense for international investors that they're more reticent to hold U.S. stocks than domestic investors? Or is it they don't like the story, but they're holding it anyway because of the typical performance of America?
So what I will tell you, I can only sort of speak about my client base, right? And so when I talk to people in the U.S., they tend to be people predominantly in the long-only community who are benchmarked to U.S. indices, right? So they are, you know, by and large, U.S. equity-focused investors, regardless of the other things that are going on. When I get outside of the U.S., I end up talking to a lot more globally focused investors, or maybe people who are owning North American funds. And what I will tell you is I do think that last year we saw more of a willingness to diversify geographically.
And I guess it worked too.
Right, it did. And you know, we had a phenomenal year in the U.S., but we had an even better year in certain other markets. Canada, for example, had a fantastic year in the U.S. equity market. My colleague Frances Donald really talks, you know, a lot about in her presentations on the year ahead about how the Canadian economy performed better than expected, even under the pressure of the tariffs. So I think at the end of the day, you know, these political issues, these geopolitical issues, they do matter. But at the end of the day, investors are also looking at fundamentals. And so if you looked at the trade we saw, you know, kind of around the tariffs 1Q, early 2Q of last year, we saw that big burst of inflows into European equity funds, and it faded pretty fast. And we saw some pressure on U.S. equity flows, and then that bounced back. And what we saw when you were seeing those inflows going into Europe is there was a moment when people were really excited about the European economy, right? So there was that fundamental excitement that fed hand in hand with some of these other issues, and you got those inflows. But then some of that excitement faded as the year wore on, and we started to see money coming back into the U.S. So what I would tell you is I know we all talk about these certain issues, right? We know the headlines get dominated by certain things, but I do think these decisions in terms of what countries you're going into, how your allocations look by region, they're driven by a complex set of issues, not just one variable.
What about where you turn to find hedges when you do get moments like that? Because yesterday shared a similarity with Liberation Day, and that's basically everything gets crushed. Bonds sell off, equities sell off, both large cap and small cap, corporate bonds sell off, Bitcoin sells off. What does that tell you about how people are protecting themselves and whether they even are seeking out hedges right now.
Well, it's funny. Back in my kind of non-U.S. week when I was up in Canada to start the year, gold was coming up a lot in conversations as well. And my colleague Chris Looney, who is our gold strategist, one of our commodity strategists at RBC who covers gold, would tell you that uncertainty, is one of the biggest drivers into that asset class. What I also noticed yesterday on the tape, though, is while small caps were getting hit, and I'm an old small cap strategist, so I'm always, taking a pretty close look at them, was that they were holding up a bit better most of the day, than the S&P 500, than the NASDAQ. And that's the other, sort of issue I would remind you of, is that we came into the beginning of the year with a lot of jitters on the AI trade. So when sectors like technology, consumer discretionary, communication services, where a lot of those big mega cap growth names are sitting, when those get hit hardest, yes, that is a part of the market that these non-U.S. investors own, but it is also just a big part of the market in general, and it kind of goes hand in hand with this rotation trade. So I know that there were a lot of jitters on the geopolitics yesterday, but we also just saw some of these rotation issues playing out as well.
It's a good point. I know you've been writing about the fact that you are more willingness to start the new year to add your once favorite children, the small caps, your old bag, but also I noticed that the Goldman Sachs index of unprofitable companies has been roaring this year too. Small caps has a lot of unprofitable companies too.
Yeah.
Do you need to see some real serious growth in the U.S. in order for that trade to actually work?
So what's curious on small caps right now is that if you look at the net income forecast, and Bloomberg does a fantastic job of tracking these in Bloomberg Intelligence, so we've been citing a lot of their stats this year, but if you look at the forward-looking estimates for 2026 on net income growth, Russell 2000 estimates are actually outstripping the Mag 7 and the S&P x the Mag 7. So it's not even necessarily a question of the economy. You've got better earnings growth forecasted. Now, there are a lot of questions on earnings quality in small cap. Are those forecasts realistic? But the data, is sort of sending that signal. I would say what's interesting to me about this moment right now for small caps is that last year they got bid up a couple times on Fed cut optimism. And we've kind of lost that tailwind right now. So, as we're sort of seeing the rotation trade gather steam, there's a lot of excitement on the cyclical economy. You still have, kind of a lackluster jobs environment. ISM manufacturing can't catch a bid. So, we feel better about small caps. We haven't gotten a completely all clear signal yet, but certainly on a day like yesterday when they're holding up a bit better, I do think that's a good sign for markets.
Well, Lori, the Fed is where I want to turn next because some of this does hinge on who we get as the Fed chair pick for this year. And there, President Trump did speak about this in Davos, Switzerland. He said he is moving closer to announcing a Fed chair. Here's what the president said.
And I'll be announcing a new Fed chairman in the not too distant future. I think he'll do a very good job. See, I gave away some of it. He did give that away. So we have something, got something. It's amazing how people change once they have the job. But it's too bad. Sort of disloyalty, but they got to do what they think is right. We have a terrible chairman right now. Jerome, too late Powell. He's always too late.
Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, I know you've been tracking that alongside the hearing over Fed Governor Lisa Cook. We'll get to that in a moment. But Trump, the only thing he gave away is that it's a man, which I think is what we largely expected.
Yeah, everybody expected that.
And it sounds also, the reporting is that Trump wouldn't reveal his pick while he was in Davos, too. This is something that keeps getting kicked down the road. Does it change the likelihood of who the Fed chair is, the fact we still don't know who it is, even though Trump has teased it so many times?
Well, it certainly could suggest that the president doesn't know exactly who he wants to choose. Bloomberg News had a great story yesterday that said that there is an effort by the administration to find somebody who meets 3 criteria, including loyalty to the president and the ability to do the monetary policy right thing, and they can't balance those 2 things. The idea that he is waiting to pick somebody does strongly suggest that he hasn't settled on someone who he feels is actually going to be able to deliver what he wants, which is lower interest rates. And so we wait to see where we go from here. Now, administration officials did tell reporters in Davos that the president's not going to announce anybody while he is there. So we'll have to wait till next week, I guess, at the earliest, but could be longer than that.
Okay, and you've also had such a busy morning, Mike. You've also been listening to the Lisa Cook hearing as well, where Powell is attending. What has been the latest with the oral arguments?
Well, excuse me. The administration is making its case first and getting some significantly skeptical questions from the justices. The Chief Justice, John Roberts, asked why the government is pursuing this at this point, since really what they're asking for is a stay of a lower court order, leaving her in place until the whole question is decided. Justice Sotomayor suggested something that I think is a real possibility from the court, and that is kick it down to the lower courts, decide whether she actually did anything wrong, and then you can decide whether or not there's cause to fire her. It doesn't sound like the court is very sympathetic to the administration's argument so far, but we haven't heard from the Cook side yet.
And Lori, if I can just bring this to you, the issue of Lisa Cook was something that roiled markets when it first came out. It's been put on the back burner. In any of your conversations, has that been brought up as a fear? I'm sure Fed independence generally has, but is anyone watching this court case?
So I would say Fed independence came up a little bit back in my December meetings, again, when I was outside the U.S. I don't think it came up very much at all last week. And to be honest, I think geopolitics just really overshadowed things to start the year. One of the things that I do tend to focus on, and we actually put these charts in our weekly, is just looking at the betting market data on, sort of outcomes around Powell and other things. And you just generally haven't seen, kind of a lot of stress in those data points from a market perspective. I think the other thing we've been watching is just for the different candidates who have been on the list, some of them have been quite high on the list for quite some time at times when markets have been rallying pretty fiercely. So, I think that markets, like, everything else, are keeping an eye on this issue, but I just don't think it's at the on the front burner right now.
One of the other things that President Trump said on stage at Davos, Switzerland during the Q&A portion, he was asked how he plans to slash the U.S. debt. And he said the big thing is growth, cutting expenses the old-fashioned way. If this is a government that wants to run things hot, how does that change your equity market outlook? And does it? Because we've already incorporated, I'm assuming, the one big beautiful bill. But what if we get more firepower pumped into this economy via stimulus?
So, when we look back to our December meetings, and I think after I kind of put out my first cut on the year ahead outlook and we were doing meetings in the States, we heard a lot about what I call stimulus past, present, and future from clients, right? And so it was the stimulus from the one big beautiful bill on CapEx, but even more so on CapEx from tax refund season, right? So that was a lot of it. But also, when we got into discussions about the midterm elections, which was often in the context of market risks, because midterm election years can quite often be difficult ones for market, as we saw both under Biden and Trump, I found that investors were saying, well, the affordability issues, that are sort of weighing on some of the polling data or might have weighed on last November's outcomes, maybe that means we're going to get even more stimulus in 2026. So it was kind of turned into a positive very, very quickly. But I will tell you, we have continued to hear those conversations from investors based in the States this year. And when I talk to investors outside of the U.S., despite some of the other issues they're grappling with, they are very receptive, right, to thinking about those stimulus issues and to thinking about the economic strength of the U.S.
Mike, I wonder when it comes to this Fed, at least its current composition, when Trump, maybe minus Steve Murin and a couple others, Myron, but when they hear something like, we're going to do it by growth, that's how we're going to eat into the deficit, that inflation becomes the problem with that.
Well, that is how that would work if you're growing significantly, and then you can inflate away the debt. Now, does the bond market want us to inflate away the debt? That's a whole other issue. But the idea that we're going to grow that fast is in nobody's forecast. It's not in the Fed's forecast. And we have literally never seen tax cuts that paid for themselves, that provided enough growth to overcome the additional hit to the deficit. So I don't think the Fed is putting much credence in that.
But surely if President Trump wants to inflate away the debt, he needs a Fed that's willing to work with him in whichever way you think, but in a way that's able to make sure that policy remains easy and maybe gets even easier.
I don't want to overstrain the analogy, but it would be a little bit like trying to get doctors to kill people instead of saving them. The Fed's whole job is to prevent inflation. They come in and they wear the badge of we don't like inflation, and their primary goal is to keep inflation down. And I don't know how you get people at the Federal Reserve to say, oh, let's have more inflation.
Mike, I totally get the metaphor and it works. I just wish it was less violent. That's my only desire. Lori, when does this line get crossed where it's like, okay, this is great, more stimulus, more growth, great for equities versus, oh, this means inflation, and inflation is bad for risk?
Look, I think at the end of the day, right, it's going to be similar to the sort of Fed's outlook on things, right, which is data dependent. You need to really see it show up in the data. And, you know, as I sort of think back to some of the work our economics team did last year, they had this one chart where they were looking at how tariffs flow through the economy, and they had like 8 or 9 different stages, right? And they also made the point that, you know, one, it takes time for these things to show up, and 2, different sectors, different industries, and even different companies within the same verticals might be, you know, dealing and baking some of these things in at different time. In other words, the idea of just sort of spreading out some of the impacts, right? And I think that's what's gone on here. And it's really caused a lot of people to say, well, inflation hasn't shown up yet, right? And, you know, our economists would say it's still uncomfortably high, but it hasn't been sort of worse than that. I think people are going to need to see it in the data.
Lori, I would love to just end with your price target for the full year, because you're still at 7,750. What is the driving force that gets us there?
So we've got 5 different models there. So I know everybody wants, like, you know, one single answer. I've never been a magic bullet strategist. We have 5 different models. 7,750 is basically roughly the median and average, and they range from 7,500 at the low end up to 8,000 on the high end. Now that 8,000 is coming from some work we've done on our valuation model, which does bake in year-end consensus views on inflation, the Fed, 10-year yields, and bottom-up consensus numbers on earnings, which is for about 14% earnings growth at this point in time. If you sort of think about the low end, we're actually getting that from our sentiment model. And what we saw with our sentiment model is that people were super bearish back around Thanksgiving, and by the time we got to the end of the year, going back to our conversation on the economy, people had gotten pretty bulled up in the States on the economic outlook for 2026. So sentiment, you know, back around Thanksgiving, about 1 standard deviation below the long-term average on AAII net bulls. It's been close to 1 standard deviation above the long-term average recently. So you've seen a little bit of a flip-flop there, which has eroded some of the potential gain from that particular perspective. But I will tell you, our Fed test is right down the middle. We're baking in, you know, sort of getting a little bit more cuts, which is the consensus forecast. Historically, when the Fed cuts between 1 and 4 times in a 12-month period, so, you know, up to 100 basis points in terms of cuts, you have a 13.3% gain in markets. And so that's right in line with that 7,750.
Hey, Lori, thank you so much for joining. What a day it's already turned out to be, and it's not even 11 a.m. Lori Calvasina from RBC, thanks for joining us. And, of course, Michael McKee, who's going to continue to track those oral arguments in the Lisa Cook case. Mike, thank you very much. Coming up, we're going to hear from Citadel CEO Ken Griffin, who's sitting down very shortly with Bloomberg's Erik Schatzker in Davos. This is Bloomberg. Happening right now in Davos, Switzerland, Citadel CEO Ken Griffin is speaking at Bloomberg House with Erik Schatzker. Let's listen in.
And the American worker, in many respects, got the short end of the stick around the world. He just did.
True. I mean, I think we can all agree that it wasn't just because of a lack of competitiveness, investment, burden sharing on the part of the Europeans. There were many American companies that went to China and gladly gave away their IP. That cost American jobs, too.
Exactly right. Exactly right. And so this, again, is where the president's done a good job and said, do you know what? We need fair trade for the United States. We need a world hierarchy in which the American worker and American businesses have a fair and level playing field around the world. And often that wasn't the case when he was president, and he's really trying to address it. I wouldn't use tariffs as my mechanism of action to do so, but I have to give him credit. He is fighting for the American worker and the American people.
Okay. So his motives, in your opinion, are
constructive.
The right ones, constructive. Let's take it up to 10,000 feet. One of the reasons that this room is so full, Ken, is because you have a quality that distinguishes you, somewhat obviously, from many other business leaders, and that is your willingness to speak out, to champion what you believe is right, and to challenge what you believe is wrong. And we saw you do that with the Biden administration. You were a vocal critic. You took issues publicly with his policies and the posture of his administration. But you're fair about it. As you put it once upon a time, country before party. You've done it to President Trump as well. In April, some of you may recall, not long after Liberation Day, you criticized President Trump for moving too fast, alienating allies, making Americans poorer, and tarnishing the sterling reputation of U.S. assets. So here we are, right? For those who aren't counting, this is the second day of the second year of Trump's second presidency. What do you think now? This is the 10,000-foot view. Is he doing what's right for America? Not just diagnosing the problem. Policies and execution are just as important.
So let's be clear. He was elected into office because of two really material problems. Number one is our southern border was utter chaos. Millions of people streamed into our country from all kinds of backgrounds, some of which, frankly, backgrounds we wouldn't want, but they streamed into the United States illegally. That's what it is. It was illegal mass immigration. And the president secured the border. I mean, he brought that to an absolute halt. And I really hope that he makes it clear that the United States still embraces legal immigration. I think we need to reiterate that point quite a bit, because one of the great superpowers of America is that we've attracted so many brilliant people from around the world, but the chaos at the southern border, he ended. Big policy triumph. The second issue that he was elected around was that of inflation. The Biden administration, we had rampant inflation in the United States, a combination of fiscal stimulus that was just beyond the appropriate levels, and monetary policy that was slow to react to the fiscal stimulus that was occurring. We had a level of untenable inflation in the United States of America. And if you were a retiree and your savings were in fixed income assets, you were seeing your future dim every single day. And you had enough. And the president is really trying to grapple with the issue of inflation. You know, it's quite ironic to see the Democrats have changed the language to affordability to try to attack President Trump for the rise in prices that largely occurred under the Biden administration. But the president right now, I think, really does have the message that he has to address the high cost of living in the United States. How do we make sure that for the American retiree or the American worker, that every dollar they have goes further and their quality of life improves?
I might come back to immigration, but specifically on the point of inflation, you have said that, in fact, to a colleague of mine not long ago, Dani Burger, that Republicans are finding it hard to accept the reality that many of the policies that they've championed, including driving illegal immigrants out of the country, are, by their very nature, inflationary.
And that's exactly right. So here's where he has a much more difficult dance. Shutting down the flow of illegal immigrants and pushing people out of our country constricts our labor markets. It's classic economics. If you reduce supply, all else being equal, prices rise. And we've had real wage growth in a number of sectors of the economy where the illegal immigrants play a very critical role in performing difficult jobs that need to get done.
And tariffs are also playing a role.
Tariffs, you know, if we look at the most recent data, the vast majority of the tariffs, the tax of tariffs, is being borne by either the American worker or the American citizen at the cash register, or by corporate America reducing their profit margins. And the president did reduce tariffs on a number of goods that are in the day-to-day shopping basket of the American people. So he understands he has to address some of the negative implications of tariffs to help address the issue of affordability.
Yes, he understands. He understands that affordability is a real issue and that it's political kryptonite in the midterms, but immigration and tariffs are big levers, hard, to counteract. Not to get too weedy here, but is he taking, in your mind, the right approach with recent initiatives such as banning institutional investors from buying single-family homes, intervening in the mortgage bond market, seeking an interest rate cap for credit cards at 10%, allowing home buyers to dip into their retirement savings? I can see why some of those measures might be welcome to American people. Is that really going to change the affordability outlook?
So I think this is where I might disagree with the president. The great power of the American economy is our embracing of capitalism. And when we when we unleash our entrepreneurs, when we unleash competition, we are able to materially improve our quality of living. And the real issue in the housing market is the lack of supply. And why do we have a lack of supply? Permitting in much of the country takes months or years to get a permit to build a house. I mean, how absurd. And then the building code has become so unwieldy and so overreaching that the cost to build a house puts it out of the reach of the average family trying to buy their first home, the home in which they'll have their dreams made. So the real issue is we need to address the regulatory burdens on the housing market. And if I were the president, I would have used Fannie and Freddie to do that. I would have said, if you are in a county that does not have prompt permitting and that does not have a reasonable building code, we will either drop the mortgage caps or we simply won't write mortgages in that county after date certain, to get our politicians at the local level to move their feet and to address the chronic problem that we have in America. We have too few of houses.
I do think it's really important for people
to
know that you're willing to say that. Yes,
the difference here?
I do.
Let the American entrepreneur get to work. And with competition and with the burden of government off their backs, they can solve the problems that we face in day-to-day life. You know,
this Ken, I mean, at least I have to give you credit for being consistent. This has been your rallying cry for the better part of 15 years, if not longer, economic freedom.
Well, I mean, maybe it's because I view what we do at Citadel as part of that story of unleashing entrepreneurs. You know, if you look at the U.S. equity market, for example, it's one of the most efficient markets in the world. And it's been driven by incredibly competitive dynamics between us and a handful of firms that have radically dropped the cost of trading for all over the course of the last 2 decades.
So since we're talking about the American economy, for the moment, we will change our focus shortly. Let me ask you, because you said on those particular issues, you take issue with some of the things he's doing. It would be great if we had more housing supply.
Or credit cards. How do we increase competition?
Right.
Like, what is it that gives a Wells Fargo or a JP Morgan or a Capital One such incredible commercial advantages that it forecloses in a material way new entry? And are there steps that we can take that are equitable that will increase competition amongst credit card issuers, that will bring down rates for all consumers on using their credit card? The worst thing we can do, if you regulate the maximum interest rate that you can charge, you actually reduce the stock of credit in society, particularly to younger people who have poor credit scores or to people who've had difficult times in life. And the younger people with poor credit scores in particular, those are people that literally start their business with their Visa card.
I want to go back
to take those entrepreneurs out of the economy, you really meaningfully reduce new firm creation, new job growth, and the innovation that makes America so special.
I would like to go back to the question I asked about whether the president is doing what's right for America. And you initially responded to me by saying he did what he said he was going to do. He tackled illegal immigration, and he's doing something about tackling inflation. That's still a work in progress, obviously. There are a number of other policies and positions that have a bearing on U.S. economic growth and U.S. economic competitiveness, particularly in the global arena. And I'd just like to understand, get a sense from you, channeling, I think, the interest here in the audience about whether you agree or disagree with where he is on the following. And you can do whatever you like, thumbs up, thumbs down. You can say agree, disagree. You can give me a little bit more, nuance. But redefining the focus of U.S. national security to the Western Hemisphere.
That is the Citadel CEO Ken Griffin speaking at Bloomberg House with Erik Schatzker, laying out what he sees as maybe Trump approaching a problem that is necessary to approach, but not in the way that Ken Griffin himself would, also echoing some of our earlier conversation that I had with Ken Griffin around the issue of inflation. You can continue to watch that conversation live go on your terminal. A quick check check on markets about in just over an hour and a half into your trading day. This is where we stand. We are much higher. We're working to erase the losses of yesterday, up by more than 1% on the S&P. The Nasdaq outperforms, up 1.3%, and yields start to ease. There's a question as to whether the sell-off yesterday was driven by JGB yields or Greenland, but President Trump in Davos, Switzerland, saying that they will not take, or we will not take, Greenland by force, and that's seeming to help ignite a rally. That is it for Bloomberg Open Interest on a day of a rally.